The year is 2008. The air in lower Manhattan is thick with the scent of fear. Not the panic of a sudden explosion, but the sickening, slow dread of a structural collapse. The financial titans, Lehman, Bear Stearns, AIG, are falling, not like dominoes, but like great stone statues crumbling in slow motion. $10 trillion in global wealth is vaporizing. Everyone is selling. Everyone is running. But 1,200 miles away, in a quiet, unassuming office in Omaha, Nebraska, a different story is unfolding. A man sits at his desk, seemingly oblivious to the screams echoing from Wall Street. He is calm. He is reading. And he is, in fact, not selling anything. He is doing the one thing that will secure his legacy, protect his empire, and fundamentally alter the course of corporate history. Close up on a pair of glasses being lowered. The man is Warren Buffett. His expression is one of patient, almost bored, anticipation. This is the story of Warren Buffett's #1 strategy before a recession. It's not about finding the next hot stock. It's not about market timing. It's an epic rescue story, a financial Dunkirk. And in this moment of peak panic, the Oracle of Omaha is not the one being rescued. He is the one arriving in a lifeboat, carrying a briefcase filled with what the world suddenly needs most: cold, hard, readily available cash. Every decade, the same narrative plays out: euphoria, arrogance, correction, and finally, the great crash. Most investors treat a recession like a bolt of lightning, unpredictable, catastrophic, and deadly. But for Buffett, a recession is not a disaster. It is the single greatest buying opportunity of a lifetime. And his #1 strategy, the one he executes before the market collapses, is the only reason he is positioned to capitalize on it when the world is burning. The strategy is deceptively simple, often ridiculed during the boom times, and yet, it has produced tens of billions of dollars in profit. It is a philosophy built on two unwavering pillars: preparation and patience. While the entire investment universe is clamoring for a better return, Buffett is focused on better solvency. He is building what he famously calls his cash cannon. The world laughs when the good times roll and the market is up 20%. They say, Buffett is losing money. His cash hoard is lazy capital. But they miss the point entirely. This strategy is not about maximizing returns in a bull market. It is about maximizing leverage in a bear market. It is about ensuring that when the financial infrastructure of the world begins to buckle, you, and only you, are positioned to be the lender of last resort. In the years leading up to 2008, as house prices soared and debt was repackaged into exotic financial instruments, Berkshire Hathaway's cash reserves climbed relentlessly, from $15 billion to $25 billion, and then beyond. His competitors, hedge funds and investment banks, were leveraging up, trying to squeeze every last drop of profit from the bubble. They were dancing on the edge of a cliff. Buffett was sitting comfortably, watching them from the safety of his mountain. Then came the fateful day in September 2008. Lehman Brothers filed for bankruptcy. The credit markets froze. The biggest, most established financial institutions in the world suddenly couldn't borrow money. Their survival depended on an immediate, massive injection of capital. They were drowning, and they needed an anchor. On September 23, 2008, the phone rang in Omaha. On the other end was Lloyd Blankfein, the CEO of Goldman Sachs. Goldman, the most prestigious investment bank on the planet, was staring into the abyss. They needed $5 billion to stabilize. They needed it now. And Warren Buffett had the money. He had prepared for this exact moment for years. But here is the central point. The secret strategy. Buffett didn't just give them a loan. He structured one of the most brilliant, most predatory, and ultimately most profitable deals in financial history. He knew they were desperate. He knew he had all the leverage, and he knew exactly how to extract maximum value from that desperation. The rescue was a $5 billion lifeline. But the terms he demanded were breathtaking. He received 10% perpetual preferred stock, meaning Goldman would pay him $500 million in dividends every year, forever, before a single dollar went to common shareholders. And on top of that, he demanded warrants, the right to buy $5 billion worth of common stock at a bargain price later. In that one single transaction, Buffett converted his lazy cash into a multi-billion-dollar windfall, simply because he was the only one in the room with both the courage and the capital to act. But wait, there's a crucial, often overlooked element to this. The true genius of his strategy wasn't just having the cash, it was in what kind of companies he targeted with that cash. He didn't just throw lifelines to any drowning company. He only invested in the financial equivalent of the aircraft carrier, companies that were structurally sound, fundamentally necessary, and simply suffering from a momentary panic. He invested in institutions that had a wide and durable economic moat. But what is an economic moat? And how can you, the everyday investor, identify and prepare your own cash cannon to copy this exact rescue strategy when the next market crash inevitably arrives? The answer lies not in finding the next Goldman Sachs, but in the surprising, almost counterintuitive assets Buffett buys years before the first siren even sounds. 2. The secret weapon revealed. To understand the preparation, we must look at the primary accusation leveled against him during bull markets. Buffett is too conservative. Critics argue that his massive cash pile, which has swelled to over $150 billion in recent years, is a drag on Berkshire's performance. They want him to put that money to work. The truth is, Buffett is putting that cash to work, but not in a glamorous way. He's not buying speculative stocks or cryptos. He's deploying the vast majority of it into the most boring, most secure asset class on the planet, U.S. Treasury bills. Why the T-bill? Because they are the ultimate financial tool of an epic rescuer. They are the only asset in the world that can guarantee three things simultaneously, which are critical to the execution of his number one strategy: safety of principal. The money is never going to zero. Liquidity. He can convert $1 billion in T-bills into $1 billion cash in literally a single day. A return, no matter how small, it keeps pace, even slightly, with inflation. This cash hoard isn't parked in a zero-interest checking account. It's a strategic weapon. When the market is booming, and T-bills pay very little, the cost of his strategy is low returns. But when the market crashes, that $150 billion is the equivalent of a fully fueled B-52 bomber, ready to drop financial aid in the form of billions of dollars to desperate, but fundamentally sound, companies. Think of it this way: the T-bill is the camouflage. The real weapon is the optionality it provides. The average investor operates under the constant pressure to be invested. They suffer from FOMO, the fear of missing out. They panic sell when the market drops, because their money is tied up in highly illiquid, risky assets. They are forced to trade when the market dictates. Buffett, with his treasury-backed cash cannon, has no such pressure. He suffers from FOMO, the fear of losing optionality. He has the ultimate power, the power of waiting. He can choose to deploy his capital precisely when the price is the most ridiculous, when the leverage is the highest, and when the desperation of the seller is at its absolute peak. But how much is enough? Is it 10% cash, 20%? The goal isn't a fixed percentage. It is a psychological threshold. It is the amount of cash that allows you to sleep soundly at night, knowing that if the S&P 500 were to drop 50% tomorrow, you would not be one of the panic sellers. You would be one of the prepared buyers. This strategic patience and the choice of the T-bill as the parking spot is the foundation of the rescue. But the second part of the strategy, the part that separates him from every other billionaire, is the most crucial of all. The biggest myth about this strategy is that it's all about Goldman Sachs and the one-off crisis deals. That's the Hollywood version. The reality is that the strategy is a daily discipline that requires incredible psychological fortitude. When a recession hits, the financial press goes dark. Pundits forecast the end of the world. Even the best companies see their stock prices plummet. In 2008, shares of Wells Fargo, a bank Buffett loved, fell over 70%. American Express, another staple, plummeted. The noise was deafening, the fear infectious. Most investors see a falling knife. Buffett sees a fire sale on quality. His strategy dictates that the purpose of his cash cannon is not to catch the bottom, but to continually, patiently buy wonderful businesses at fair prices when the world has priced them as trash. He knows that the value of Coca-Cola, the world's most recognizable brand, with a massive moat, doesn't change based on a quarter of bad economic news. It only makes the stock cheaper. His rescue mission isn't just about saving banks. It's about saving value from the chaos of the market. And the key to understanding which companies he rescues, and which ones he ignores, lies in a phrase he coined decades ago. He calls it the economic moat. This is the second, inseparable half of his pre-recession strategy. If the T-bill cash hoard is the ammunition, the economic moat is the target. Without a clearly defined, durable moat, Buffett won't touch a company, no matter how cheap the price. Because if a company is truly going to be rescued, it must first be able to survive the crisis on its own. But what are the 5 types of economic moats that Buffett is hunting for? The ones that guarantee a company will not only survive a recession, but emerge from it stronger than ever. And how does one seemingly small, but brilliant, investment he made in the 1970s perfectly illustrate the power of this principle? Transition to the next section detailing the 5 moats and the 1970s investment, driving the viewer forward. 3. The 2008 crucible. His rescue mission isn't just about saving banks. It's about saving value from the chaos of the market. And the key to understanding which companies he rescues, and which ones he ignores, lies in a phrase he coined decades ago. He calls it the economic moat. This is the second, inseparable half of his pre-recession strategy. If the T-bill cash hoard is the ammunition, the economic moat is the target. Without a clearly defined, durable moat, Buffett won't touch a company, no matter how cheap the price. Because if a company is truly going to be rescued, it must first be able to survive the crisis on its own. The moat is the competitive advantage that allows a company to keep rivals at bay and earn higher returns on capital for many years. When a recession hits, the tide goes out, revealing which companies are swimming naked. Buffett only buys the ones wearing battle armor. There are 5 main types of moats Buffett hunts for. Intangible assets. This includes brands like Coca-Cola or Apple, which command pricing power. People will pay a premium because of the name alone. Switching costs. Think banks or software providers. The pain, cost, or complexity of switching to a competitor is so high, customers simply stay put. Network effects. Platforms like Visa or American Express. The value of the service increases as more people use it. Your credit card is worthless if no one accepts it. Cost advantage. Companies like Geico or Costco that can produce a similar good or service at a significantly lower cost than the competition, allowing them to undercut prices or simply earn higher margins. Efficient scale. Businesses in a market where a competitor entering would immediately drive down returns for everyone. Think regulated utilities or railroads. His number one strategy isn't just about holding cash. It is about holding cash in reserve to deploy only on wide moat companies during a period of maximum fear. Let's return to the 2008 crucible. The phone call from Lloyd Blankfein to Buffett was a moment of profound financial humility. Goldman Sachs had a strong moat. It was essential to the global financial infrastructure, but it was facing a liquidity crunch, a momentary cash flow issue, not a fundamental business issue. Goldman needed to project confidence. A public investment from the world's most trusted investor, Warren Buffett, was worth more than the $5 billion he gave them. It was a stamp of approval that essentially said, this patient is sick, but he is going to live. The terms he received were not just generous, they were historic. Preferred stock giving him a 10% yield, guaranteed. This meant that while the stock market was in free fall, Buffett was guaranteed a $500 million payout every year. He wasn't relying on the volatile common stock price. He was relying on the bank's inherent need to survive. This is the defining difference. Buffett seeks senior secured assets when everyone else is buying common stock. He uses his cash not to gamble on recovery, but to act as a bank to the best companies in the world, securing massive, high-yield, debt-like payments, while everyone else is playing the volatile common stock game. But the rescue story doesn't end with Goldman. 3 years later, in 2011, the financial crisis hangover dragged the stock of Bank of America, to its knees. The market was still paranoid, beating down Bank of America shares as low as $5.50. Buffett's phone rang again. This time, It was Bank of America's CEO Brian Moynihan. The bank was financially sound, but politically and psychologically fragile. They needed the Buffett endorsement. Buffett deployed his strategy again. Another $5 billion, again, in the form of preferred stock that paid a lucrative annual dividend, 6% this time, and again, with warrants to buy millions of shares of common stock at a ridiculously low price. The result? Bank of America's stock immediately soared 25% the next day. The investment provided the credibility the bank desperately needed. In total, Buffett's two recession-era investments in Goldman and Bank of America, totaling $10 billion of cash, returned tens of billions of dollars. And it all came down to one principle: preparation allows you to name your price when the desperate must sell. But how does this epic, multi-billion-dollar rescue translate to the average investor with a 401k or an IRA? You don't have $5 billion. You can't demand preferred stock. The answer is that you don't need a cash cannon. You need a cash slingshot. The principles are exactly the same, but the execution requires a deep understanding of your own emotional triggers. 4. The philosophy of moats and discipline. The 5 most important words in investing, according to the Oracle's long-term philosophy, are margin of safety. This is the true intellectual underpinning of the rescue strategy. Buffett's mentor, Benjamin Graham, taught him to never buy a stock for exactly what it's worth. Always buy it for significantly less. This difference is your margin of safety, your investment insurance policy. In a recession, the margin of safety for great businesses can become enormous. A company worth $100 might trade for $40 due to panic. This is when the prepared investor deploys the slingshot. You're not gambling on the future, you are taking advantage of a temporary, irrational panic that has created a massive discount on a high-quality asset. This requires incredible emotional discipline. The market's natural inclination is to sell low and buy high. The media, the charts, and your own fear will scream at you to sell. Buffett's strategy dictates that you must flip this psychological switch. You must be fearful when others are greedy, and greedy when others are fearful. But how do you cultivate the necessary fear in a bull market and the necessary greed in a bear market? It goes back to preparation. During the boom, when everyone is making easy money and stocks are flying high, you must consciously, intellectually, and patiently build your cash position, your slingshot. This isn't just about saving. This is about establishing a specific percentage of your overall investable assets that you will hold only in high-quality, high-liquidity assets like short-term treasury bills or high-yield savings accounts. For the average investor, this slingshot should be somewhere between 10% and 20% of your investable assets. This amount will vary based on your age and risk tolerance, but the purpose is absolute. This money is reserved for crisis only. It is your capital for the epic rescue of value. When the market drops 30%, 40%, or 50%, you don't sell your core portfolio. You start deploying the slingshot. You are no longer scrambling for money. You are no longer selling at a loss. You are calmly, strategically, and courageously buying. The difference between a value trap and a value buy in a recession is the moat. The crisis is like a flash flood. The value trap is a weakly built house that gets washed away. The value buy is a solid brick foundation, temporarily covered in mud. In the next section, we're going to give you the toolkit, the exact 3 metrics and the 2-step process that Buffett and his team use to identify the wide moat companies that are worth rescuing, separating the fundamentally sound from the structurally unsound. Specifically, we will reveal the one financial ratio Buffett calls his owner's earnings proxy, which is the ultimate test of a company's true economic moat. A ratio most everyday investors completely ignore. The toolkit for the everyday investor. The difference between a value trap and a value buy in a recession is the moat. The crisis is like a flash flood. The value trap is a weakly built house that gets washed away. The value buy is a solid brick foundation, temporarily covered in mud. In the next section, we're going to give you the toolkit, the exact 3 metrics and the 2-step process that Buffett and his team use to identify the wide moat companies that are worth rescuing, separating the fundamentally sound from the structurally unsound. Specifically, we will reveal the one financial ratio Buffett calls his owner's earnings proxy, which is the ultimate test of a company's true economic moat. A ratio most everyday investors completely ignore. Buffett is famous for saying that accounting statements are the beginning, not the end, of business valuation. He doesn't look for flashy top-line growth. He looks for predictable, internal profitability, the kind that survives a recession. This profitability is best measured by three core ratios that serve as his moat testing criteria. For the everyday investor, these are your diagnostic tools. 1. The moat test, return on equity, ROE. The first, and perhaps most important, test is the return on equity, ROE. ROE measures how effectively a company is using the money shareholders have invested to generate profit. It is the ultimate measure of management's efficiency and the strength of the business model. A high, consistent ROE suggests the presence of a wide economic moat. If a company can reliably generate a 15% or greater ROE every year for a decade, through booms and busts, it means competitors simply can't touch its efficiency or pricing power. Look at Coca-Cola or American Express. Their ROE figures rarely dip into single digits, even during downturns. Why? Their intangible assets, brand and network, allow them to maintain strong margins when others are forced to cut prices. 2. The resilience test, debt-to-equity, D/E, ratio. The second test is the debt-to-equity, D/E, ratio. A recession is the ultimate stress test. Companies financed by massive debt are the first to be crushed by a liquidity crisis. They are the ones that need rescuing. Buffett prefers companies that fund their growth through retained earnings, profit, rather than through borrowed money, debt. His ideal D/E ratio is low, ideally below 0.5. This means the company has more capital from its owners than from its creditors. A low D/E ratio is a sign of resilience. It means the company doesn't need to fear the next credit freeze. When the market is scrambling for loans, the low-debt company is the one with the balance sheet strength to deploy its own cash cannon for acquisitions and expansion. 3. The owner's earnings proxy, free cash flow to revenue. Now, for the key to Buffett's true economic earnings. He invented the term owner's earnings to describe the cash an owner could take out of a business each year without hurting its competitive position. It's not simply net income. His closest proxy for this metric that you can easily calculate is the free cash flow to revenue ratio, or the free cash flow margin. Free cash flow, FCF, is the cash generated after paying for all expenses, including the capital expenditure, CAPEX, needed just to maintain the business, the necessary repairs and maintenance. If a business needs to constantly pour money back into its assets just to stay in the game, its FCF will be low, and its moat is weak. Buffett looks for companies that consistently generate a free cash flow margin of 5% or greater over the long term. This indicates a pricing power moat, the ability to generate substantial cash from every dollar of sales. This is the ultimate proof that the company is a cash-generating machine, not a capital-consuming monster. This is the litmus test for the rescue. The two-step slingshot strategy. The rescue mission is not complete until the everyday investor integrates the preparation, the cash cannon, with the analysis, the moat test. This creates the two-step slingshot strategy for navigating any economic downturn. Step 1. Build the slingshot. The pre-recession phase. During the boom, ignore the noise and the FOMO. Commit to building your 10% to 20% cash reserve in a highly liquid, secure account, T-bills or high-yield savings. Crucially, create your buy list now. Apply the 3 moat tests to a handful of companies you understand, which pass the Buffett criteria. Set your target purchase price based on a margin of safety. How large should your margin be? Warren Buffett learned from Ben Graham, if you understood a business perfectly, you would need very little in the way of a margin of safety. Since none of us are perfect, aim for a minimum 20% to 30% discount from your calculated intrinsic value. For example, if a wide moat stock like Coca-Cola has an intrinsic value of $60, your target buy price is between $42 and $48. This target price is the rescue price. Step 2. Deploy the slingshot. The crisis phase: when the market panics, you don't panic. You execute the rescue plan. When the stock price of your moat-tested company drops to or below your predetermined rescue price, you deploy a fraction of your cash slingshot. Do not deploy all of it at once. Buffett is a serial buyer during crises. If the market drops 30%, you deploy a third. If it drops another 10%, you deploy another third. You are buying in tranches, recognizing that the bottom is unknowable. This action is the single most important difference between long-term wealth creators and short-term speculators. The speculator sells in fear. The prepared investor becomes the rescue capital, acquiring high-quality assets at historically low prices. This is the Buffett blueprint. 7. The final chapter: Crisis and Opportunity. The epic rescue story of Warren Buffett is not simply about an old man with a checkbook. It's about the timeless power of discipline over emotion. Every recession is a test. It tests the strength of the businesses you own, and more importantly, it tests the strength of your character. Most people see chaos. Buffett sees a transfer of wealth, from the impatient to the patient, from the leveraged to the liquid. In 2008, he wasn't just rescuing Goldman Sachs, he was rescuing the principle of value investing. He proved that the boring, conservative preparation of holding treasury bills was the most aggressive, powerful, and profitable strategy. When the world needed it most, the market will boom again. The market will crash again. The sirens will sound. Pundits will cry doomsday. But you now hold the blueprint of the ultimate rescue mission. You have the toolkit to identify the unshakable castles, and you have the slingshot to acquire them at a massive margin of safety. Remember his final word of advice, given decades ago: the business schools reward difficult, complex behavior more than simple behavior, but simple behavior is more effective. Your job is not to be brilliant. Your job is to be prepared. Start building your slingshot. Identify your moats. Set your prices. And wait patiently for the market to hand you the opportunity. Because when the next crisis arrives, you won't be running for cover. You'll be signing the papers on the best investments of your lifetime. You will be the rescuer.